Okay, so does anybody hear of Code Section 199A? Probably not. But this is a special code section that applies to flow-through entities. So this applies if you're a Schedule C filer, single member LLC. It applies if you're a partnership. It applies if you're a subchapter S corporation. Those are considered for this purpose flow-through entities. The advantage of this code section is that it reduces your taxable income for federal income tax purposes only by 20%. Big deal. This law was introduced when Trump passed his Big Tax Act because he dramatically lowered corporate tax rates for large corporations. And to make it fair for small businesses, what he did was he said, all right, all small business owners, they're going to get an added tax break as well for being self-employed. Now, unfortunately, I'm going to get into the unfortunate in a minute, but let me just give you an example. So let's assume your flow-through income from your S corporation this year is $100,000. You're going to basically pay tax only on $80,000 of it. $20,000 of it will not be subject to tax. That's a deduction not at the business level, but on the front of your 1040 on your personal tax return. Now, here's where the catch comes in. A rule was passed that if you're in what's called a specified service, trade, or business, there's limitations based on your income as to whether or not you're going to be entitled to it. So for those of you that are dentists, which I assume is all of you, everything you do as a dentist falls under that category, specified service, trade, or business. So what does that mean? What that means is you could still take advantage of this, but your taxable income has to be below these thresholds. So, for example, if you were single and your taxable income, we're not talking about your gross income, but your taxable income is under $170,000, 20% of your flow-through income is not going to get taxed at all. As you approach $220,000, it gets phased out. If your taxable income is over $220,000, none of this applies to you. Now, if you're married, the situation is different. The amount is literally doubled. So you could have taxable income of $340,000 and still be entitled to this 20% tax break. As a matter of fact, you could go up to $440,000 and still get a partial deduction. In 2023, these thresholds have gone up. So all of us know inflation this year has been out of control. Some of the good news about that is that a lot of the tax tables, a lot of the deductions, the limitations, amount you can deduct, those are adjusted for inflation every year. So there'll be more of an opportunity to take advantage of these things. So using the 2022 versus 2023, you could actually earn $24,000 more and still fall under this category. Now, I'm going to give you an example of another dentist that I worked with about, I'm going to say it was about 3 years ago, once this law came into effect. And this guy, God bless his soul, very aggressive guy. He had multiple practices in Manhattan. He eventually decided to relocate to Long Island. He's got a very successful practice in Long Island. But one thing I love about him, he listens to what I say. He follows my instructions to a T. But sometimes he takes it further than I would want to see him take it. So this is a true story. So he was planning to get married in January of, I forget what year it was, I think it was 2021. He was planning to get married. I came in for year-end planning, and I said, Joe, unfortunately, your income is above the Section 199A deduction because he was making somewhere around $350,000, $400,000. No, I think it was about $300,000. That's where he was. So I said to him, by the way, I know you're getting married next year. I know your wife-to-be, it was actually his hygienist who was making a lot less money. I said, when you combine both incomes, you're actually below the threshold for married filing jointly. Okay? So guess what he did? He went home, talked it over with his fiancée. He went to City Hall and got married that year legally. He still had his wedding ceremony in the following year, but because he did that, we were able to file him as married filing jointly. Now, you wouldn't think about talking to your investment advisor, your tax advisor, about the fact you're getting married, but because we had that conversation, he saved a significant amount of money. Actually, I think when we went through the math, he saved himself about $35,000 in taxes. That $35,000 in taxes either paid for the wedding, I think it definitely paid for the honeymoon, it probably paid for the ring as well, and that was only because of using sound tax smart strategies. So had you known this just before you got married, you probably would have done the same, right? Maybe, maybe not. But I do love that story because it's a true story, but I never expected a client to go to that extreme to force the issue and get married earlier for tax purposes. And again, that's $30,000 after tax money, so that's real money. Okay, so now when we were talking about entity choices, here's a big difference. When it comes to entity choices, sole proprietorship, single member LLC, we know the IRS audit risk with them are dramatically higher, but I still recommend that you do that in the early stages of your practice. The reason I recommend it is because with a Schedule C filer, sole proprietorship, or a single member LLC, all of your income gets reported on your personal tax return. That means 100% of your flow-through income is subject to the Section 199A deduction, so you can literally wipe out 20% of all your income from being subject to federal tax. That's a big deal. If you're a subchapter S corporation, the rules are a little different. Why? Because you're taking a salary. You have to take a W-2 salary. That you don't get the benefit of this Section 199A deduction. What you do get the benefit from is whatever profit flows through to you, whatever money you made that you didn't take in the form of a salary. So in the early stages of your practice, when you're still under these income thresholds, I'm encouraging all of my newer, younger dentists, it could even be an older dentist that just went into practice later on, but if your income is below that threshold, I still think it's worth using that entity choice. Once your income goes over that threshold, then at that point, if you're an LLC, single member LLC, we make a simple election to treat you as a subchapter S corporation, and then going forward, we're going to give you all the advantages of being a corporation. So if the Section 199A deduction doesn't apply to you, chances are I'm going to tell you, let's be a sub S corp. If they do apply to you, then the single member LLC may be better for you. All right, so good stuff so far. Hopefully each of you are learning something that you could actually go back and apply in your own practice. So this is another common mistake that people make. They pay for business expenses. Remember I told you I have clients that pay for everything through their business account, and I tell them you can't do that. We spend more time trying to get that bad stuff out of there that doesn't belong there. But then there are people that mistakenly pay for things that are tax deductible personally. Well, let's again use that same example. You paid for today's course. You paid for parking today at the garage. If you paid for all that on your personal credit card and didn't deduct it through your practice, you're going to get no business deduction for it. So I used to tell my clients during year-end planning meeting, even though you're pretty sure you didn't do that all year, just go through your personal credit card statements, your personal, for the whole year. Go through your personal checkbook for the whole year. See if you mistakenly paid for something that could have been related to your practice. If it was, write yourself a reimbursement check for that expense before the end of the year. And you'd be surprised, stuff like that happens more often than you would think. Okay, and again, this is especially important now because for the last 3 years, personal unreimbursed employee business expenses, not deductible at all, where through your practice, there would be 100% deductible.